Hello again. Welcome to part 2 of the Chapter 2 presentation, Accounting 2410. We left off last time with the organization of the balance sheet. Now we're going to move on into a totally different area, that of ratio analysis. Now, when we talk about financial ratios, we're talking about an expression of the relationship among selected items on financial statements, as it says in slide 22, which is our starting point for this part of the presentation. So a ratio expresses the mathematical relationship between one quantity and another in a meaningful way for a user to help them determine what type of financial shape this company is in, besides just a reading of the financial statements themselves. So ratio analysis helps you to drill a little bit more deeply into the financial condition of a company. Now I'm going to segue just a little bit because in between waiting for videos to upload and so forth, I'm looking at emails and posts, and one suggestion that was brought up was that I use the video to present a few sample problems, actually going through them perhaps in writing in some way. Now, in order to do that, I'm probably going to have to procure a small whiteboard and a marker that's dark enough where you can see it. You can see I have a desktop screen lit up in back of me, and there's actually something there, but to you it just looks bright white. So obviously the video graphics aren't the greatest here, and I'm going to have to figure out how I can present that type of an actual live problem solve in a way that you're going to be able to see it all right. But I will work on doing that in the meantime. Moving to slide 23, there are three basic types of ratios that measure different aspects of a company's financial health. Profitability ratios measure the profitability or operating success over a period of time, normally a year, but it could be extended to gauge performance over a longer period. Liquidity ratios are computed to measure the company's ability to pay its current obligations, both expected and perhaps unexpected. Solvency ratios measure the ability of the company to survive over the long haul, including meeting its longer-term obligations. Each of these measures uses unique sets of data from the financial statements, and we'll get into the specifics of that shortly. Moving to slide 24, as the text states, ratios can be used to compare performance between periods for the same company, compare the company to industry averages for the industry it is in, or intercompany comparisons with direct competitors. In looking at the income statement on this slide, shown on page 55 of the text, by the way, several intra-company comparisons, that is, comparisons between periods for the same company, can be made. For starters, it's maybe somewhat disturbing that although the company in this case increased its revenue from 2008 to 2009, it didn't make as much net income, the bottom line result. We can see that the two major items of expense, cost of goods sold and selling, general, and administrative expenses, went up. However, this knowledge alone may not be sufficient. We'd want to know why these costs went up, and there may be numerous reasons or just a few. Moving to slide 25, this slide discusses the profitability measures of earnings per share. As you can see, this measure is computed based on the formula of net income less any preferred stock dividends divided by the common stock shares average balance during the year, as computed by adding the beginning and ending balances of shares outstanding divided by 2. Note why the preferred dividends would need to be subtracted from net income if they were in fact paid. That is because preferred stock, as you may be able to tell from its name, is stock that takes precedence over common stock when it comes to order of payout to shareholders. Therefore, the preferred dividends would need to be subtracted before the true earnings per common share are computed. Note also the drop-off in earnings per share, or EPS, between 2008 and 2009, which is not a good thing. Shareholders want to see a healthy EPS because that is one of several factors that affect the market price of the stock. Okay, moving to slide 26, a review question. In this case, the corporation reported net income of $26,000, net sales of $400,000, and average shares outstanding of 6,000. And there were preferred stock dividends of 2,000. So the question is, what was the 2010 earnings per share? And you can see on the completed slide here that calculation is shown, and it comes out to $4 per common share based on the net income of 26,000 minus the preferred dividends of 2,000 divided by the average outstanding share balance of 6,000. Moving to slide 27, and using the statement of stockholders' equity to do some financial analysis. The statement of stockholders' equity is different from the retained earnings statement in that it kind of expands on it. That is because for publicly traded companies, common stock, and perhaps preferred stock as well, needs to be accounted for along with retained earnings, net income, and dividends. The example on this slide and page 57 of the text shows some typical changes that can occur with the common stock of the company as new shares are issued and existing shares are bought back. Notice also how this statement covers two periods, both 2008 and 2009. Moving to slide 28, see the discussion on page 57 between two shareholders as to why Best Buy did not pay dividends prior to 2003. Financing business expansion is often a reason for holding off on dividends. The company believes it will get a better return for itself and its shareholders by growing the business in the short run. The other bullets on this slide provide some observations from the statement of stockholders' equity on page 57. Take a moment to see why these statements are true. And on slide 29, review question again. The balance in retained earnings is not affected by the issuance of common stock. The other three responses do affect the balance in the retained earnings account. Moving to slide 30, the balance sheet contains a wealth of information that can be used to help determine the liquidity and the solvency of the company. One measure of liquidity is the company's working capital, which is simply the current assets minus the current liabilities. Positive amounts of working capital give us some comfort that the company can cover its short-term obligations. Negative working capital, however, is a cause for concern, although it's not necessarily reflective of a liquidity problem. Further investigation would be needed to confirm this one way or the other. Liquidity ratios expand on what working capital shows to provide other liquidity measures using the balance sheet. The current ratio is simply the current assets divided by current liabilities. We're looking for a value greater than 1 for this ratio to be solid. Since the current ratio is a ratio, not a subtraction like working capital, it's a more reliable measure because it removes the significance of the difference between current assets and current liabilities. That is, working capital for one company may be far greater than working capital for another based on sheer numbers, but the current ratio for the one with greater working capital may actually be lower. For Best Buy, the current ratio slipped below 1, a 1-to-1 ratio in 2009, and that's well below the industry average, which would be a cause for some concern. Slide 31, not only did Best Buy's current ratio slip, its working capital fell from a positive number in 2008 to a negative $243 million in 2009. that obviously is not very good either. On slide 32, notice the narrative explanation for what the current ratio is telling us about Best Buy's liquidity. That is, for every dollar of current liabilities in 2009, Best Buy has only 97 cents of current assets. So that's what the current ratio is telling us. That's a graphic portrayal of the company's ability or potential inability to cover its short-term obligations. On slide 33, this little sidebar is shown on page 60 of the text. It's possible that a company may be carrying too much working capital for its own good, when that excess could be better invested elsewhere or used to pay down debt. On slide 34, based on the definition of solvency presented on this slide, there are some ratios that help us gauge the company's ability to service its debt payments and interest over time. On slide 35, the main solvency ratio we discuss in this chapter is debt to total assets. This is computed simply as total liabilities divided by total assets. The lower this ratio is, the better for the company's solvency. Notice on page 60, Best Buy's debt to total assets ratio went up by 6%, not a good trend, from 2008 to 2009. This increase makes Best Buy a riskier business to invest in than it was before. On slide 36, the review question here, the reason that D is the correct answer is that it correctly states that Lear has higher liquidity as evidenced by the current ratio being higher than stable, but lower solvency is evidenced by the lower debt to assets ratio. Also, the earnings per share alone is not enough to determine which entity is more profitable. We would need to look at the net income of each, the ratio of net income to sales, etc., to get a better handle on that. On slide 37, the debt to assets ratio can vary greatly between industries and companies depending on their business model and the way they are financed. Understand why this is by looking at the Microsoft versus General Motors difference in the debt to assets ratio and the explanation as to why this is the case found on page 96 of the text. On slide 38, free cash flow is an important measure showing a measure of the company's cash generating ability that goes beyond the cash provided by operating activities in the statement of cash flows. The formula for free cash flow subtracts cash expended for capital items and cash dividends from the cash provided by operations for a more accurate measure of the company's cash generating ability. See Best Buy's example on page 62 and notice the dramatic difference between cash provided by operations and free cash flow when the other two items are subtracted. Free cash flow is considered a measure of solvency because it's an indicator of the company's ability to acquire new assets, retire debt, or pay additional dividends, most of which has to do with the longer term that solvency measures are concerned with. And here's just another example of computing free cash flows. Again, cash provided by operating activities, minus expenditures on property, plant, and equipment, and minus dividends paid will give us that free cash flow amount. And with that, that concludes part 2 of the Chapter 2 presentation.